Okay, let's talk about something you hear about all the time: the U.S. trade deficit. For nearly half a century, America has been buying way more from the world than it sells. It's this huge, nagging economic puzzle. Politicians are always vowing to fix it. But what if the whole way we think about the trade deficit is just wrong? What if it isn't the problem everyone says it is? Let's dive in and unpack this.
So, first things first, let's just get a sense of the scale here. It's kind of staggering. Over the last 3.5 decades, you look at the major players, right? You've got these massive surpluses piling up in countries like China, Germany, and Japan. And then you have the United States. It's in a league of its own, just this enormous, persistent negative balance. The US is, without a doubt, the planet's #1 buyer.
So that just begs the question, right? Why? I mean, how did the US become this outlier? Why this gigantic, never ending deficit when other countries are on the complete opposite end of the spectrum? Well, the answer, it's definitely not what you'd expect. And figuring it out actually tells us something really fundamental about America's unique place in the entire global economic system.
All right, so to get to the bottom of this mystery, let's start by doing a little detective work. First up, we're going to round up the usual suspects. These are the explanations you've probably heard a million times.
Yeah, you know the ones I'm talking about. The most common arguments focus on the actual stuff being traded. We hear it all the time. We're importing too much because of cheap foreign labor, or other countries are cheating with subsidies. On the flip side, you hear, well, our exports are just too low because American manufacturing can't compete anymore. And look, these arguments, they sound plausible, right? They make a certain kind of sense. But the truth is, they're missing a massive piece of the puzzle, a really crucial one.
Okay, now if you corner an economist, they'll bring up something a little more technical. It's called the savings rate theory. And all it really says is that a country's trade balance equals its total savings minus its total investment. So if you have a deficit, it just means you're investing more than you're saving. For the US, this is a fact. The country invests more than it saves. It's technically correct, but, and this is a big but, it doesn't actually tell us why that's happening. And this quote just nails the problem with that whole theory. It's just a description, not an explanation. It's like asking someone why a cup of water overflowed, and they just look at you and say, well, because there's too much water in the cup. Yeah, thanks, I got that part. The real question, the one we need to answer, is why is there so much water getting poured into America's cup in the first place?
And this is where we get to the heart of it. The reason all those standard explanations just don't cut it is because they leave out a huge, critical variable. It's this devilish little thing that changes the entire equation, the exchange rate.
Okay, so here's how this is supposed to work, in Econ 101. Exchange rates are meant to be this amazing automatic balancer. Think about it. If a country has a trade deficit, it means they're constantly selling their own currency to buy foreign stuff. Basic supply and demand says their currency should get weaker, right? It should depreciate. And when your currency is weaker, your exports suddenly become cheaper for everyone else to buy, and imports become more expensive for you. And voila, the trade balance should naturally start to correct itself. It's supposed to be a perfect, self-fixing system. And this is the central mystery, isn't it? If this beautiful, self-correcting machine is supposed to exist, why has it been completely broken for the United States for almost half a century? Why doesn't the US dollar just get weaker and fix the problem? Answering that question, well, that's where we find the real story.
See, the reason that mechanism looks broken is because we've only been looking at one half of the picture. The whole story of international money flow isn't just about trading cars and iPhones. There's a whole other side to the ledger. And once you see it, everything clicks into place.
And here it is. This is the big reveal, the whole story right here. On one side, you have the current account. That's the trade deficit we've been talking about. A huge negative number. But look at the other side, the financial and capital account. It's an almost perfectly equal and opposite surplus. They mirror each other. So for every single dollar that flows out of the US to buy foreign goods, a dollar flows right back in as an investment. They're two sides of the exact same coin. They have to balance. So what exactly is this financial account? It's pretty simple, actually. It just tracks money that's flowing across borders for investment purposes. So when a German car company builds a new factory in South Carolina, that's money in. When China's central bank buys a ton of US Treasury bonds, that's money in. It represents this unbelievable, nonstop flood of foreign capital pouring into the United States. Okay, this next part is absolutely critical. It's the key takeaway. Most people have the cause and effect completely backwards. We think the trade deficit is the problem we need to fix. But the reality is,
The rest of the world's massive, relentless demand to invest in the US creates this huge financial surplus. And that surplus, by the simple laws of accounting, is what forces the US to run a trade deficit. The investment surplus is the cause, the trade deficit is just the effect.
Which, of course, leads to the next logical question. Why? Why on earth is there such an unstoppable global appetite for US assets? The answer to that question has everything to do with the special, incredibly powerful role of one thing, the US dollar. It's all part of this incredible self-perpetuating loop. Just follow the money. Step 1. Foreign countries sell stuff to the US and get paid in US dollars. Step 2. What do they do with all those dollars? They can't just stick them in a vault. They need a safe place to park them, so they hold them as foreign reserves. Step 3. They invest those reserves back into the US, buying things like Treasury bonds, the safest financial asset in the world. This creates a huge demand for dollars, which, step 4, keeps the dollar's value high. And finally, step 5, a strong dollar makes imports super cheap for Americans, which encourages them to buy more foreign goods, which creates the trade deficit. And boom, the cycle starts all over again.
And you know what's wild? If you look at the history, the timeline fits this theory perfectly. The US trade deficit as we know it, this massive permanent thing, it basically starts right after 1971. And what happened in 1971? That's the year the US officially cut the dollar's ties to gold. That single move basically unlocked the dollar, setting it on the path to becoming the world's undisputed reserve currency. And it's what kicked this whole global cycle into high gear.
And look, don't just take my word for it. This isn't some wacky fringe economic theory. The US Federal Reserve, the people in charge of the dollar, they say the exact same thing. This quote from the Fed lays it out in black and white. When you can buy anything you want from the world just by printing your own money or issuing debt, you're pretty much destined to have a trade deficit. It's a feature, not a bug, of the system.
All right, so after all that, we have to ask the big question. Is this whole situation good or bad for the US? And the honest answer is, well, it's complicated. The best way to think about a trade deficit is that it's just a symptom, not the disease itself. And whether that symptom is a sign of good health or bad health, that depends entirely on what's causing it.
Here's an analogy. Think about having a fast heartbeat. If your heart is pounding because you just went for a great run, that's a good thing. It's a sign of a healthy, functioning body. But if your heart is racing while you're just sitting on the couch, that's a sign something's wrong. It's the same with deficits. A country like Australia has run a deficit for ages because global investors are pouring money in to fund growth. That's a healthy, just went for a run deficit. But the deficits you saw in Greece or Spain before their crisis, that was a sitting on the couch deficit, a sign of deep economic problems. For the most part, the US deficit is the healthy kind. It's a symptom of the world wanting to invest in America.
So that leaves us with one final really big question to chew on. Since we now know the trade deficit isn't some kind of economic failure, but a direct mathematical result of the dollar's power and the world's demand for US investments, is it actually a problem that needs solving? Or is it just the unavoidable price America pays for the incredible, unparalleled power that comes with having the world's reserve currency? Now that's the real trade-off at the heart of this whole thing.